Welcome to This Explainer. Today we're unpacking the hidden machinery of the American financial system. We usually think of debt as just some static number sitting on a bank server somewhere. But today, we're exploring its shadow life. What actually happens the exact moment someone falls behind on a payment? Well, let's find out.
To really get this, just imagine an everyday consumer. They put, say, $5,000 on a credit card. At first, everything's completely normal, right? They make their monthly payments, the credit card company earns its fees, everyone's happy. But then, suddenly, things change. A job loss, a massive rent spike, maybe a medical emergency. The payments, they just have to stop.
Now, most people think the story ends right there, don't they? The bank loses money, the borrower can't pay, game over. But in reality, this is literally just the beginning of a massive, highly complex financial journey. The big question we have to ask ourselves here is who actually makes money when you can't pay? Like, how many different businesses can profit off this exact same debt before the story is truly over? Okay, so the crucial shift here is all about how this money is perceived. Think about it. To a consumer, an unpaid $5,000 is just a massive source of anxiety, right? It's a stressful financial burden. But the financial system? They view that exact same $5,000 in an entirely different light. To them, it is not a loss. It's a highly valuable, tradable asset with expected future cash flows. Boom. Your debt just became a commodity. This right here is the central aha moment of our whole journey. And around this newly transformed asset, a massive ecosystem springs to life. We aren't just talking about a couple of companies passing papers around. No, this is a sprawling, multi-billion-dollar network of businesses that profit purely from collecting, servicing, buying, reporting, and financing your unpaid consumer debt. This whole industry is interacting with your debt long after you miss that very first payment to your original bank.
So how exactly does a personal loan physically leave the bank and morph into a Wall Street commodity? Let's trace its path.
It generally follows a really fascinating three-step path. First up, the original lender expects their money, so they try to collect it themselves. But if that fails, they have to run a cold, hard cost-benefit analysis. Is it actually worth spending more money to chase this down? If the answer is no, they push it to step 2. This is where they hire a third-party collection agency to pursue it for a fee. And if they just want to wash their hands of the whole shebang, we arrive at step 3. The debt is sold outright to a specialized debt buyer. This exact moment is when your debt officially becomes a traded commodity on the secondary market.
Now, the math that makes this entire trade possible is all about risk and reward. Imagine a massive portfolio of distressed debts, originally worth, say, £10 million. A debt buyer is definitely not paying $10 million for it. Because of the sheer uncertainty of actually recovering that money, they scoop it up for pennies on the dollar. Their entire business model relies on recovering just enough of that $10 million to cover their steep discount and turn a profit. The bank gets a tax write-off, the buyer gets a cheap asset. It's an entire industry built entirely on the gap between what's owed and what can actually be collected.
As this asset travels further and further away from its origin, it encounters a vast array of specialized corporate players, all wanting a piece of the pie. It's basically a financial relay race, and guess what? The baton is your personal data. It's almost mind-boggling how many different corporate hands are suddenly touching a single missed credit card payment.
I mean, just look at how crowded this field gets. This isn't just a relationship between you and your bank anymore. Your single debt can involve loan servicers, collection agencies, debt buyers who grabbed it at a massive discount, credit reporting companies logging all the data, and even debt settlement or bankruptcy professionals. And here's the kicker. Every single one of these entities operates with entirely different economic incentives. That is absolutely crucial to understand. Some get paid to collect, some get paid to process, and some just analyze the risk. This conflicting web of incentives is exactly why the consumer experiences so much chaos.
Let's just zoom in on one of these players to show you how confusing this gets and why it really matters to you. Take the loan servicer, the company you think you're paying each month, the one with the official logo right there at the top of your statement, might actually just be an administrative front. They process the payments, they keep the records, but the secret? An entirely different financial institution, like a massive debt buyer or an investment trust, actually owns your underlying debt. You're basically interacting with the front desk, while the tradable asset itself sits locked away in someone else's vault.
But as this debt bounces around between all these various corporations, servicers, and buyers, we really have to look at the real-world impact. Because behind every single one of these tradable assets is an everyday consumer just trying to navigate this massive financial web. It creates this stark power imbalance, right? You have a monolithic, highly optimized industry on one side and a single person on the other who likely doesn't fully understand the machine they've just been pulled into. And this brilliantly illustrates how a single missed payment snowballs over time. At 1 month, it's just a missed payment. By 3 months, the account is severely delinquent and often charged right off the original bank's active books. By 6 months, it's moving into the hands of third-party collections or being sold off as a distressed asset. But the longest tail is at the very bottom. For years 1 through 7, this journey aggressively latches onto the consumer's credit report, dragging down their score long after the debt has been bought and sold by total strangers.
This creates a really powerful human tension. It forces us to ask a difficult question. Does a temporary financial struggle inevitably become a permanent financial identity? Because this lasting mark on a credit report dictates everything: your access to future mortgages, auto loans, even basic credit cards. The financial system's ongoing trade of your past debt is literally dictating your future financial freedom.
And the sheer complexity of this trade brings some really serious risks. Because this ecosystem is so incredibly massive, and the data is changing hands constantly between lenders, buyers, and servicers, things easily get lost in translation. Consumers face severe protection concerns. Imagine being an innocent person getting a threatening phone call for a debt you already paid off years ago, simply because a single line on a spreadsheet got corrupted during a massive portfolio sale. We're talking about incorrect balances, identity confusion, or being aggressively chased for outdated debts. When a debt is sold 3 or 4 times, the paperwork? Yeah, it isn't always perfect. Now, to understand this ecosystem accurately and fairly, we have to impartially balance 2 very real competing interests. On one side, you have the reality of legitimate debt recovery. Creditors have a legal need to recover funds. Without that ability, they just wouldn't extend credit in the first place, which is the very thing that allows people to buy homes and handle emergencies. But on the flip side, there is the absolute necessity of consumer protection. Consumers require strict, enforceable safeguards against the systemic errors, identity confusion, and harassment we just talked about. Both sides of this coin are absolutely essential to a functioning economy.
As we pull all these threads together, the ultimate revelation of this explainer is perfectly summed up right here. This same debt can have different meanings depending on who is looking at it. Think back to our original $5,000. If you're the struggling borrower, you view it as a heavy burden. If you're a debt buyer, it's a distressed, tradable asset with massive upside potential. For a collection agency, it's a potential recovery fee. And for a financial analyst, it's just a measurable data point of risk. It's one single debt, but multiple, entirely different realities.
So as we wrap up our journey following that initial mispayment all the way through the secondary market, I want to leave you with one final thought. When debt becomes a massive, tradable industry, a pure commodity, rather than a relationship between a person and their bank, we have to ask, is this system designed primarily to help people get back on their feet, or is it designed simply to ensure the money keeps changing hands until someone, somewhere finally pays? It's a fascinating reality of our financial world, operating quietly in the background every single day. Thanks for joining me on this explainer, and keep questioning how the systems around us really work.